So here's my current portfolio. $35,000, $71.87. As you can see, it's like a 23.78% return in 1 month, which almost $7,000. Not too shabby. Here are all my calls that I sold or have selling. Most of them expiring on the 12th of November, which is in 2 days. One expiring on 19th of November and one Aflac expiring 3rd of December, just because Aflac dropped so much that I decided, I don't know if it was a good decision, but I decided to sell a call with a longer expiration date. But now that I think about it, I should probably just stick to selling calls within that week and just bite the bullet, even if I'm only making like 0.4% return instead of a 1% return on a given contract, just because there is a likelihood that the stock will go back up the 3 or 4% it dropped, and then next week I can write a call and make that 1% in that 1 week. Whereas in this case, I literally wrote this call out like a month in advance just so I could make 1%, or maybe not even close to 1%, I can see. But Aflac, yeah, so if it doesn't sell, I'm only making 0.4% return. If it does sell, I'm making 1.15, but I literally wrote that a month. I wrote it on the 1st of November and it's expiring 3rd of December, meaning that in 1 month, the lowest percentage I can make is 0.4%. That's not a good return on that call. So if I would have just stuck to my gun and at that time, November 1st, just sold a call expiring on 11/5, then only make like 0.2% return, if that, 0.15. And then Aflac does go up, which I think Aflac, how's Aflac doing? Yeah, so Aflac's pretty much where I bought it at. Yeah, like almost exactly there, like a little above. So if I would have just done that, and this week I could have sold a call and made a lot more premium, probably more than that 0.4% return that I'm having in 1 month. So that's one mistake. I don't know if it's a mistake, but learning process, because I'm not going to lose any money. It's just going to make more money if I thought that through a little more. And the same is said for this Bumble call. I sold that call like 3 weeks out instead of my normal typical 1 week. So I think I should stick with 1 to 2 weeks. Maybe just only do 2 weeks if I have a stock that dropped a lot in price. And I also want to discuss something else. I've added something new. It's my Bitcoin. I actually started doing Bitcoin covered calls. I bought Bitcoin at 62,344, and currently it shot up to like 66,000, which is a lot more than what it was. It's like a 6% increase from what it was, but I'm not worried about that because it doesn't really matter. I sold the call with a strike price of 64,000, so I'm probably going to sell. And with it selling, I'll make $28.30, which doesn't seem like a lot, but for only having put in $623.44 initially, and making $28.30, that's a 4.54% return in 1 week off of options trading cryptocurrency, which is pretty neat. And I found this website and I'm able to do that. I might add more money in, but I think I'm just going to mess around with this small account value at first and just see how it takes me. Right now I only have like $709 in there, but that's enough to write one contract, and one contract is 1/100th of a Bitcoin. Instead of 100 shares of something, it's 1/100th of a cryptocurrency, which is pretty cool. I think for Ethereum, it might be like 10 contracts per coin, just because obviously the price is lower than Bitcoin. But Anyway, that's cool. And I also wrote these other calls. I wrote Snap with a strike price of 56, $69, 5 contracts. If it does sell, I make a 2.85% return. If it doesn't sell, I make 1.25, expiring the 12th. Also expiring the 12th are Bank of America, Virgin Galactic, and AT&T. Bank of America, 4 contracts, strike 47.5, premium $56 a contract. If it does sell, I will make $176, 0.92%. If it does not sell, I will make $224, which is 1.18%. Virgin Galactic, 2 contracts, $20 strike from my initial buy price for those 200 shares, $19.01, $89 a contract. If it does sell, I will make 9.89% return. And if it does not sell, I will make a 4.68% return, which is pretty cool because right now Virgin Galactic is above $20, which means that it probably will sell. And for those 200 shares, I will make a 9.89% return, which just shows the power of buying it. Is right here, I bought it. Same strike price, $20, but a 0.28 per share, so $28 a contract. So I only was making 1.47% when it didn't sell, and it didn't end up selling. So I got to move on to this week. Sold it, and now it's going to end up selling. And because the stock was slowly increasing, but now it's to the point where it increased a little bit more, I'm making a full 9.89% return off of that one trade with the 200 shares, which is pretty cool. AT&T, I initially bought it $25.08. Expiration date is the 12th of November again. Strike price $25, premium $28 a contract, 3 contracts. I don't think it's going to sell, and that's $84 and 1.12% return, but I guess we'll see in the next coming days what happens. That's it for my trades. And yeah, that's pretty much it. Right now I currently have an idea of loaning money either anywhere. Banks give personal loans anywhere from like a 5% to 10% APY. So I'm thinking out worst case scenario, paying a 10% APY. So let's say, for instance, I get $100,000 from the bank, paying 10% APY monthly. That's like 0.83. Actually, let me see. 0.1 divided by 12. Yeah, 0.833% return. 0.833% interest. And let's say I also take a margin off that. Margin APY for Robinhood is 2.5%. So 0.025 divided by 12. That is a 0.208% interest each month. So that plus my 0.1 divided by 12. With that, I could get a buying power of 200 grand and only need to pay interest for 1.0416%, which is super nice. Assuming that if I have months like this and can make 23% in 1 month, which I doubt it, I'd rather aim for like a 5 to 7% return in a month. Or if dealing with high volume of money, such as $200,000, for instance, and I aim for like let's just say even a 3% return. Yeah, let's say I aim for a 3% return each month, and I'm paying 1%. 0.03 minus that 1% would give me a 2% return. 2% of So yeah. So I'd have to pay. Here, I'm rethinking my math. So I'd have to pay 1% a month on the $100,000. And on the $100,000, if I'm aiming to make 4% a month, which I think could be doable by aiming for 0.5% each week of the $200,000, which would be a 2% return that month of the $200,000, which would be a 4% return for the $100,000. So let's say I make 4% of the $100,000 and I have to pay 1% of that for the interest. 3% would be my total profit from that month, which would be a $3,000 profit per month, assuming that's all getting paid back to the loan. Then I could profit 36 grand in 1 year just off of free money if I could find someone that would loan me the money or find a personal loan for that much. But the same idea could be applied to any amount of money, any volume. And that's my current idea. I'm just saying it now just so I can look back and think about it. This whole thing is just a experimental thought process tracker where I can look back at my previous states and see what I was thinking. I don't know if I had talked about this already, but not a mistake I made, but just something I'm learning is that I probably would only want to stick with selling calls only like a week out in advance or 2 weeks. Well, of course, a week. A week is what I do normally, but like with this Aflac call, I sold it literally a month out, and my least profitable area could be 0.44% return if it doesn't sell, which I think is honestly kind of stupid I did that. It's just because Affleck dropped in price a lot, so I was like freaking out kind of, but I sold a call farther out in expiration. I'm like, oh, it's fine. I'll make like 0.5 to 1% return, which isn't bad at all, honestly. But if I was smarter, I would have sold it out like if I sold it like 1 week out, then it would be probably like a 0.1% return, which is pretty bad. But assuming I thought the stock would go up, back up, then the next week I could sell a call again for 1% if it goes back up to the normal price that I bought it at. And I don't know. It all just depends, like, if you're bullish or bearish still in that next, like, 2 to 3 week time period. So I think at the time I must have been thinking Aflac was going to keep dropping, which is stupid because it had a lot of support on the bottom area. So I don't. Now that I look back and see that Aflac went back up in price, and if I would have just sold a call for 1 week in advance, and I could have been selling calls on that Aflac 200 share group, I could have been making my full 1% return for the next 3 weeks that I sold this call for and have to wait it out now. It's kind of dumb, but that's just one thing I noticed. And same thing said for, there's one more that's a little farther out. Oh yeah, Bumble. That's just because Bumble is down, but Bumble's still pretty down, so I think I predicted that right. But Bumble did come back up around that $50 strike price, so I could have sold a call and sold another one the week after if I would have done it weekly, and I probably would have ended up profiting more. But by setting the expiration date out farther, I just take away from the not stress, just work needed to maintain these shares and maintain my positions. And so, I mean, that kind of makes sense. But if I really want to aim for the highest returns, and I think that the stock will go back up to whatever price it was with just like a 1 week fluctuation in price, then I should really limit myself to selling calls that are only 1 to 2 weeks out in advance instead of a full month. This is one of my first calls that I sold out. That was like a full month out. I've really only been selling 1 to 2 weeks into expiration. So, I mean, it's still considered a short call. I've never really sold any long calls, and I don't know if I plan to because I don't know. I still don't know what stocks I fully trust. That's why I don't really have any long-term positions held, and my covered call strategy is very in the money to say, not in the money, but I cut it very close. I don't really anticipate stocks to go up, nor do I anticipate them to drop a crap ton. So I kind of just bank on the fact that I know the stock market is unpredictable. At least it is to me right now because I'm pretty new to this and I don't try to predict what stocks are doing as much. And I don't bargain for the worst and I don't plan for the worst to say, but I definitely give myself a lot of insurance. And those are my final thoughts. Thank you.